Welcome back to Investing Talk Podcast. We are zeroing in on a really critical question today, looking at the sources you sent over about Dow. Our mission is, well, to try and cut through the noise, make sense of the analyst reports, and figure out the current investment climate. And the main question is pretty simple. Is Dow a good buy right now? Before we really jump into the data, just a quick reminder, please subscribe, like us, leave a comment below. We really do thrive on your engagement. And hey, if there's a specific company you want us to look into next time, just let us know in the comments.
Yeah, this analysis feels really necessary right now. The source material paints a pretty stark picture, actually. A company facing some serious headwinds. We're talking fundamental issues, psychological ones too. Deteriorating forecasts, big moves like that dividend cut, and a really unfavorable sector ranking. So for any investor, getting clarity on these competing risks is, well, it's paramount.
Okay, let's unpack these numbers then, because the fundamental expectations are challenging, to say the least. We're looking ahead to the Q3 earnings report. That's due October 23rd, 2025. And the consensus is, well, it's jarring. Analysts are projecting a negative EPS of minus 31 cents.
That figure, that's a catastrophic 165.96% decline year over year. That's not just a slowdown. It's a fundamental reversal in earning power, probably driven by those macro pressures we keep hearing about. And what's really crucial for you, the listener, to understand is just the sheer magnitude of that decline. When EPS flips from positive to, deeply negative like that, it signals core profitability is under severe pressure.
And that pain isn't just on the bottom line, is it? Revenue's also looking rough. Projected at $10.18 billion, which is a drop of 6.47% compared to last year. So this isn't just margin compression we're talking about. It's an actual loss of sales. I have to ask, when you see quarterly data this negative, especially for a legacy company like Dow, is there any historical precedent where they bounce back fast?
Yeah. History suggests a quick snapback like that is pretty rare.
Yeah.
And what's maybe even more concerning is how these immediate quarterly estimates feed into the full year picture. The full year estimates. They anticipate an EPS of minus $1 and revenue projected at $40.75 billion, which is a 5.15% decline. So we're talking about a full year of pretty substantial erosion, top and bottom lines. This directly contradicts, any bullish thesis built on some kind of quick recovery or a V-shaped bounce back.
Right. That must put the analysts in a really pessimistic mood then. And we see that in the revisions, correct?
Oh, absolutely. Analyst sentiment is crumbling. Over just the past month, EPS estimates have moved 15.27% lower. 15%. This is what we sometimes call chasing the stock down.
Yeah.
They're kind of forced to downgrade their models because the company or maybe the whole sector is just reflecting such poor forward visibility.
And that flows right into quantitative stuff, like the Zacks rank we saw. That's a systematic way of measuring exactly that downward revision pressure, isn't it?
Yes, exactly. Dow currently rates as a number 4, which is a sell, on the Zacks rank. For listeners maybe not familiar, the Zacks rank is heavily weighted by these earnings estimate revisions. So #4 signals that professional analysts aren't just pessimistic, they're actively slashing future earnings expectations, and faster than for competitors. It's a powerful quantitative red flag, basically. It confirms the consensus view is fundamentally pessimistic right now.
Now, for listeners maybe hoping for a silver lining somewhere in the data, we have to be really clear based on the sources. We couldn't find any verifiable info about, say, margin improvement or raised guidance or even strong free cash flow that might balance out these fundamental headaches. The numbers really are the story here, and that story is contraction. Okay, let's shift gears a bit. Let's talk about recent actions and shocks that have hit shareholder confidence, because this is where the market psychology seems to turn pretty negative too. We absolutely have to talk about that news from July 2025, the quarterly dividend declaration.
Right. The declared dividend was 35 cents per share, which was a huge reduction. A full 50% cut from the previous 70 cents. Companies typically only take a step like that when they're facing a real financial pinch or maybe preparing for a long period of heavy investment where they need to preserve cash. Dow framed it predictably as enhancing financial flexibility amid, macroeconomic challenges.
Yeah, it's logical for the business, maybe protecting the balance sheet. But it's a massive psychological blow for investors, isn't it? Especially income investors. You saw the impact of that cash preservation strategy, even though, okay, they did pay their 456th consecutive dividend in September. So they signal commitment, sure, but despite the reduced payouts, like commitment to a half-size relationship.
Exactly. Well put. And the market's perception of risk only got worse with the legal pressures. In August, right after that dividend cut, the company got hit with a class action lawsuit. The suit basically alleged false or misleading statements about Dow's ability to mitigate those exact economic headwinds they were citing for the cut. So that puts an extra spotlight on management credibility and, of course, introduces unknown legal costs and liabilities down the road.
Wow. It's a tough environment to navigate. And the sector itself isn't helping matters, is it? Let's look at the industry context.
Yeah, the sector context is perhaps the biggest anchor dragging on the stock right now. The chemical diversified industry, where Dow sits, currently ranks in the bottom 7% of all industries. That's 230 out of over 250. That's just massive relative weakness. It tells you pretty much every other company in this space is struggling with the same macro pressures, maybe even worse. So Dow is fighting against a tidal wave here, not just, a small ripple.
Okay, so given that context, that almost everyone in their space is struggling, how hard is it for one company like Dow to actually decouple itself from that dismal sector performance?
Oh, decoupling is incredibly difficult in that situation. It requires something extraordinary, really unexpected news. Either, a massive proprietary innovation that nobody else has, or maybe a big strategic pivot, perhaps through M&A, that fundamentally changes their business model away from that macro cycle. Without something like that, they're likely just going to track the performance of the bottom 7% of the market, which isn't good.
Right. And speaking of performance, let's touch on the recent technical action. The stock closed at $21.90 on October 16th, 2025. What's the price action telling us lately?
Well, the price action pretty much confirms everything we've just discussed. Over the past month, Dow has underperformed significantly. It's down 9.54%. And critically, that happened while both its own sector, basic materials, and the broader S&P 500 were generally flat or even posting small gains. So that underperformance suggests two things, really. Specific selling pressure, maybe related to the dividend cut and that lawsuit, and also just a lack of conviction from buyers to step in, even at this lower price level. There's just no positive momentum.
Okay, so this definitely raises an important question for investors, right?
Yeah.
What are the near-term events that could actually act as inflection points? Things that might either confirm this pessimism or maybe suggest a possible shift. What should we be watching over the next, say, 3 months?
The absolute crucial event is that upcoming Q3 earnings report in late October 2025. Investors really need to scrutinize not just the headline numbers, which frankly we expect to be poor based on estimates, but also management's commentary. What they say about Q4 guidance, their forward outlook, that's key. This report will be the first real test of whether that dividend adjustment has actually provided enough financial breathing room.
And outside of the company's own report, what external factors should investors keep an eye on?
Yeah, there are some key market mechanics to watch too. Late October often brings ETF rebalancing, which can cause short-term price swings as funds adjust their holdings. Might not be fundamental, but it moves the price. Then in mid-November, we get the institutional investors' buy reports, the 13F filings. Seeing whether major funds are dumping shares or maybe quietly accumulating Dow, that signals institutional conviction or the lack of it.
And there's a less obvious catalyst, too, related to consumer behavior, right?
Absolutely. You have to remember, Dow supplies materials used in things like packaging and various consumer goods. So holiday sales reports, which start trickling out in early November, they give you a crucial insight into consumer demand health. If demand for packaged goods tanks, Dow feels that impact pretty much immediately in its order book.
Now, we did see some, let's call them speculative catalysts mentioned in the sources. The kind of whispers that often accompany a struggling stock.
Right.
We heard general rumors about a potential macroeconomic recovery, which, as we noted, would probably lift the entire sector if it happened.
Right. We also saw some rumors about, new product development, something exciting in the innovation pipeline, the hope that maybe they have a breakthrough product coming. And of course, there's always speculation about M&A or strategic acquisitions that could potentially re-rate the stock.
Yeah, but it's really essential here to contrast those, let's say, hopeful rumors with the reality we've been analyzing from the verifiable sources. What did we actually find to back up any of that speculation?
Basically zero. We found zero verifiable sources confirming any impending M&A, no confirmed positive news pipelines, no specific new product launch schedules that look imminent. So while these rumors are always part of the market chatter, for a genuine investment decision, you really have to discount them until they appear in official company communications or filings. Hope isn't really an investment thesis, especially when the current fundamentals are signaling this much distress. So, okay. If we try to synthesize this whole picture, the declining earnings, that big dividend cut, the lawsuit, the sector weakness, and this lack of confirmed positive catalysts, Where does this actually leave a potential buyer today?
Well, the technical price target suggests some upside, but the overall consensus still feels pretty lukewarm, doesn't it, at best?
Exactly. The analyst consensus is currently hold. The average 12-month price target is around $28.07. Now, that does imply decent potential upside from the current $21.90, but, and this is the critical nuance, that target is built on very soft footing. Only 7%, just 7% of analysts actually have a buy recommendation. The overwhelming majority are saying hold.
Which means, basically, analysts are acknowledging the stock is probably cheap relative to its history, but they have almost zero conviction that the bad news cycle is actually over yet. They're essentially saying, yeah, maybe wait and see.
Precisely. They're holding their breath. Our overall bullish rating, kind of synthesizing all the conflicting data in the sources, it sits at a pretty weak 4 out of 10. That's really not a strong endorsement by any measure.
So pulling it all together then, who exactly is this stock for right now? Because it's clearly not suitable for everyone.
Yeah, based on all this information, Dow looks absolutely not compelling for short-term traders or momentum strategy investors or even traditional growth investors right now. It just lacks the positive technical setup, the growth projections aren't there, and there are no clear near-term catalysts to justify taking that kind of risk.
Okay. So instead, this stock seems attractive only for a very specific, maybe niche type of investor.
Yes, I think so. It seems strictly for the contrarian or maybe the deep value-oriented investor, someone willing to accept significant risk and bet on a turnaround that might take multiple years. These investors are trying to look past the immediate pain. They might view that 50% dividend cut as a necessary evil to protect long-term capital. And they're essentially betting that the entire chemical diversified industry is at or very near its cyclical bottom. But crucially, they have to be prepared to wait, possibly for a long time, for a material, verifiable improvement in the fundamentals. We're talking positive EPS growth again, not just numbers that are less negative.
That's a really crucial distinction, isn't it? You're betting on a fundamental recovery, not just a continuation of the current, slightly less bad trend.
That's the core risk. And maybe here's a final thought for you to mull over as you consider this stock. We established that its industry, chemical diversified, is performing terribly, right? Bottom 7% of the market. So considering that huge headwind, what specific measurable scale of rumored internal innovation, or maybe M&A, would actually be necessary to truly decouple Dow from those powerful macroeconomic and severe sector pressures? The investment decision seems to hinge entirely on verifying future positive news, like seeing a real turnaround in those projected negative $1 EPS figures. And you can only really verify that by reviewing the most recent SEC filings, the 10K, the upcoming 10Q, and official company communications, not by relying on the current pretty grim consensus picture or market rumors.
Right. The verification step, checking the primary sources, is always the difference between a calculated risk and just, well, blind speculation. Thank you. That was a really meticulous analysis of Dow. We certainly hope this breakdown helps guide your investing journey out there. Thanks for listening to this Investing Talk podcast. Don't forget to subscribe, like, and definitely comment. We'll catch you next time.